Do you ever feel you're just guessing? You see a breakout, you jump in, and immediately get stopped out. Or you see a market chopping around and you have no idea where it's going next. The reason is you're not understanding what the market is actually doing. You're looking at candles, but you're not reading the story. In this video, I'm going to break down the one concept that changed everything for me, auction market theory. This isn't some magic indicator. This is the underlying logic of why the market moves. If you get this, you'll stop guessing and start anticipating. Let's get into it. The market has one job. So, what is auction market theory, or AMT? Forget all the complex academic definitions. Here's all you need to know. The market's only purpose is to facilitate trade. It's a giant auction constantly moving up and down to find a price where buyers and sellers agree to do business. That's it. It's trying to find what we call fair value. Think about it. When price is in a range, chopping back and forth, what is happening? The market has found a fair price. Buyers and sellers are happy to trade in that zone. We call this balance. On your charts, this balance area looks like a bell curve. We call this the value area, and it's where roughly 70% of all the trading activity happens. Right in the middle, the level with the most volume is the point of control, otherwise the POC. This is the fairest price of them all, the price where the most business got done. But what happens when new information hits the market? A news event, a big player stepping in suddenly. That fair value isn't so fair anymore. That's when the market goes into its second state, imbalance. This is your trend. The auction is now aggressively moving, trying to find a new area of fair value. So, to put it simply, balance equals range. Buyers and sellers agree on price. Imbalance equals trend. They disagree and one side is in control. Your job as a trader is to identify which state the market is in, and more importantly, when it's about to switch from one to the other. The head fake versus the real deal. So the big question is, how do we know if a breakout from the value area is real or just a trap? This is where we need to understand two key types of activity. Responsive activity, the head fake. This is the expected behavior. Think of the value area as a magnet. If price pushes above the value area, the market sees it as overpriced. What happens? Sellers are expected to step in and slap it back down into value. That's responsive selling. If price drops below the value area, the market sees a bargain. Buyers are expected to scoop it up and push it back into value. That's responsive buying. This is the cause of most fakeouts and stop hunts. The market is simply testing the waters and snapping back to where it's comfortable. Initiating activity, the real deal. This is the unexpected behavior, and it's where the big moves happen. This time, when price pushes above the value area, sellers don't slap it down. Instead, more buyers show up, agreeing that this new, higher price is fair. They initiate trades at this new level. This is how trends are born. The market's perception of value has literally changed, and it's now seeking a new, higher balance area. Acceptance versus failed auctions, how to read the clues. Okay, this is the most important part. How do you tell the difference in real time? You look for acceptance or a failed auction. Failed auction, rejection. This is your fake out. Price breaks out of the value area, but there is no follow through. What it looks like. You'll see long wicks on the candles. The price spikes out and is immediately and aggressively pushed back toward the value area. Volume. The volume on the breakout is weak. There is no commitment. What it means. The market is rejecting the new price. It was a liquidity grab, a stop hunt, and nothing more. Acceptance. This is your confirmed real deal breakout. What it looks like. Price breaks out and stays out. It starts to consolidate and build volume outside of the old value area. It feels calm and controlled, not spiky and erratic. Volume. You see an increase in volume confirming the move. Big players are stepping in. What it means. The market accepts the new price. Participants agree that the old value is gone, and they are now establishing a new one. This is when you look to get in on the retest. The 5 rules to put this into practice. So let's make this super practical. Here are 5 simple rules based on everything we just discussed. Number 1, if the price accepts back inside a balance area, it is highly likely to travel to the other side. The auction is trying to explore the entire range. Number 2, inside a balance area is choppy. Expect price to reject the edges, the value area high and low. Don't get caught trying to trade breakouts within the chop. Number 3, once the price accepts outside the balance, it's likely to trend. The market is now imbalanced and is hunting for the next area of value, which is often the point of control of a previous balance area. Number 4, a strong reaction from the point of control can stop a move in its tracks. The point of control is the ultimate level of fair value. Treat it like a powerful magnet. Number 5, if volume and time build up at the edge of a balance area, prepare for a breakout. This is a sign that the market is coiling up and getting ready to move into an imbalance phase. Auction market theory is one of the most significant breaking points in my trading, as it shed a new light on understanding market dynamics and behaviors. That's going to conclude the end of this video, and thank you guys for watching until the end.